We see the NASDAQ, it's sort of rolled over a little bit. It didn't even get that strong today. Apple and NVIDIA are still having some problems. How significant do you think that is?
Listen, I think obviously this is the big debate right now, but I think clearly for me, when you look through the index, everybody's down. But the bulk of the damage is being done by Apple, which is, as everybody knows by now, largely worries about China, overblown or not. NVIDIA, the entire semi-space, there's a couple of tech conferences across the street. The semiconductors are speaking everywhere, reiterating that there's weakness, particularly out of China. So NVIDIA is getting caught up in that, plus the valuation.
That, right? Broadcom's down this week. The SMH is down near 4%.
Yeah.
Taiwan Semi's down near 4%. Your point's well taken about what's happening in chips.
Yeah, but then at the same time, when you dig through the index, through the tech stocks, you know, like the cybersecurity names are still doing super well. Old tech like IBM and Cisco, Oracle is basically at a high. I'm obviously not advocating for them fundamentally, but when there are these other names across the index, the software space like Adobe is sitting close to a high. There's pockets of strength that are offsetting some of the weakness for these idiosyncratic issues.
Are we in a buy the dip, as I raised this question at the top? Or are we still in that environment, which is the thing that has kept the market as resilient as it's been? There was some talk that sort of the flavor of the market had changed to sell the rip. If you're going to get any rip, you're going to sell it. What do you think about that?
No, I think it's still a buy the dip mentality. At the end of the day, what you're dealing with in a broad market standpoint is earlier in the year, you're looking out towards the trough in earnings, which now seems almost surely to be the case here in the second quarter, an economy that's continuously proved resilient and now actually appears to be expanding. Q3 GDP is probably going to be stronger than Q2, which itself is stronger than Q1. And so until something fundamentally changes on that front, I don't know why the bias for stocks isn't going to be higher.
Well, Greg Branch is going to join us momentarily. He's going to make the case, as he has for months. And we'll debate it when he comes on. This idea that, well, next week you get CPI, you get PPI, so you get more critical inflation data, a lot of focus on the Fed. You got a meeting in a couple of weeks, so they're going to key off of that. You think they're done or not?
I don't know. On the CPI, I will say, I mentioned this last time, it bears repeating. I don't think people are aware that next week, well, we're closer now, so they might be more aware, but next week's going to be a pretty hot headline number. The headline inflation rate's probably going to be higher for the second month in a row. And through the remainder of the year, some of the things that have brought down inflation, like the airline fares and health insurance, are probably going to start working against you. And so I think you're going to have some stability in the CPI, so to speak. For all year long, I've been saying my target for the end of the year was 2.5 to 3.5 for the CPI. That's almost surely going to be accurate, although probably closer to the higher end of that range. As for the Fed, are they done? I mean, listen, I think they certainly want to be done. But the stickiness in inflation that I just articulated, the jobless claims number that fell back down to 200, the strength you see throughout the economy, I mean, certainly they're not cutting anytime soon, but they might feel it necessary sometime later this year, or at least pressure to maybe do one more.
Two of the three key inflation sort of gauges, there's like three critical parts to this story, and two of them have really gone in the right direction. Goods inflation is not even close to what it was. Housing services inflation seems to certainly have peaked.
Oh, sure.
And is coming down. It's non-housing services that have remained a bit sticky, probably more sticky than the Fed would like, and that's where they maybe need to lean on things more. But at least two of the key three things are going in the right direction.
Yeah,
are we appreciating that enough?
Well, yes, I think people recognize. Listen, you're past the peak and close to the bottom are two different things, obviously. And I want to say two things. The first, on the rent side of things, there's two publicly traded companies, Invitation Homes and American Homes for Rent, INVH and AMH. These are publicly traded single-family rental firms. They own 80, 50,000, lots of homes. They're still printing rent numbers in the 7.5%, 8% range. Now, obviously, that's not all of the housing market, all of the rental market, but it's a microcosm of it, and that's still pretty healthy. And with respect to the Fed and everything else, as investors, why this matters, of course, is because if they're going to keep raising rates, you're going to keep leaning on the economy. And there's a great debate right now. I'm not even positive it's still a debate, but a great discussion around whether inflation has fallen from, call it 9 to 4 because of the Fed or despite the Fed. And the answer to that question and the discussion around it is really important for investors, because if the Fed caused inflation,
it's even fallen closer to 3. I mean, at this point.
Well, sure. I mean, at the next number it'll be 3.7, but whatever. Yes, 3 to 4%. But if it has fallen from 9 to 3 or 9 to 4 because of the Fed, then monetary policy is having an effect. They don't have to really do very much. Stocks can rally.